All right, so we're going to be focusing on learning objective 1 for chapter 12. Sorry, chapter 13. Oh my God, yeah, lucky 13. So learning objective 1 starts about the concept of sustainable income. And we talk a lot about what sustainability is. There's actually even degrees on sustainability. But what it means is really what can last. You know, what's realistic that can last. And that's what's sustainable, right? And so when you're talking about sustainable income, remember sustainable profits, right? The level of profitability that's most likely to continue for a company, okay? And that really relates to its main operating activities, right? So for Walmart, you know, the sustainable income is simply by the likely level of profit that it's going to get by just continually selling goods, right? Not all the other stuff that might happen to the company, but just its sustainable business, right? And how does that look? And so, you know, of course, the college is having a different issue with sustainable income. And so there, you know, every organization needs to look at what's sustainable, what is something that could be kept up very likely, you know, for a while. Well, what ruins this concept of what's sustainable is all the other issues that come up in a company that create what's called unusual items that affect the earnings. And so when we look at the quality of the income statement and you're looking at profit and loss, there's sustainable income from what it normally does, and then there's all this other crap that happens that basically interferes with the calculation of profit. And these are the unusual items that sort of happen to a company. And there's two that this chapter deals with, okay? The first is what happens when a company discontinues operation. And so that could happen for a couple of ways. One way is the company can close down a part of itself. So let's say it's not going to make product X anymore. So they're going to close down all of the factories and business activities related to product X. And so that's a discontinued operation for, say, closing up a product line. But they can also sell part of their operations to others. And that's also discontinuing it, but it's discontinuing it in a different way. You're not going to be doing it anymore, so you're going to be discontinuing it from your business. Another business has picked it up, purchased it, and will continue it on their records. But in accounting, we keep all that separate, right? So for our company, even if we're selling off a piece of ourselves, technically that's discontinued operations as well. Okay. Another thing your book talks about is looking at, and we haven't really delved into the details yet, we will in this chapter, of what is considered comprehensive income to a company. And this is something that we're going to be dealing with here in this learning objective here, and you'll find out a little bit more about this as we go. So unusual items are what we consider irregular, right? Like I said, there's normal activity for Walmart to be, you know, its normal activity is buying and selling goods. But then there's all the other types of things that could happen that affect the income statement. Because if we take a loss on something or we have a gain on something, that's going to show up on the income statement. If we make extra income or have other extra expenses from things other than selling goods, that's going to show up on the income statement. So we look at that and say, you know, how these are unusual, are they irregular? Okay. Because if they're irregular, they don't really mean as much to how profitable the company is, because we have to look at its main business and separate all these unusual items from the main operations. So this is where it gets a little tricky, and you're going to be doing a little extra reading here. So here is this company, Cruise, and I think this is on, yes, it's on page 648 in your book. It's a very strange looking 6, but it's a 6. Page 648. And here they have an illustration showing the statement of comprehensive income, right? So that's not just your traditional simple income statement. This has all this other stuff added to it, like discontinued operations and other income items that are shown in red on the statement. The rest of it, the statement looks like you've seen it before, right? You start with sales revenue, subtract out cost of goods sold, you get gross profit, right? You subtract out all the other operating expenses, you get the income from operation, right? You have this other category of other expenses and losses that provides you a profit before you calculate your tax. You calculate your tax, and what you would normally get is net income. The issue here is that in a comprehensive income statement, we look at that as income from continuing operations, and now we need to take into consideration some of these unusual items. So the first thing it takes consideration is there are some discontinued operations. So this particular company, Cruise Company, which is explained in your book. It doesn't give you specifically what they do, at least when I read it, it didn't. But it seems to have discontinued operations. They actually had sold off something in their operations, and it looks as though they made a profit from selling off their discontinued operation. And so the discontinued operations, after taxes, added another $30,000 of profit for the company that year. Okay, again, this is only for the year. That's an unusual item because how frequently can you sell off that division? Once. And how much profit can you make off of it? Well, it's usually a one-time shot in this case, per division. Some corporations are huge, but this particular company looks a little smaller. So they sold off this operation. They made money from the sale of the operation. And so they technically need to show that on their income statement. It's an unusual item, but it shows up on the income statement. So their actual net income is actually greater than it would be if they just looked at the continuing operations, you know, the day-to-day stuff if it's normal business activities. Then there's this other category that we're going to be looking at today, other comprehensive income net of tax. So in this case, this is additional amounts of profits that the company must declare from whatever these items are, and they'll talk about it in the book as we keep going. And as you see, it added an additional $10,000 of profit to the company's bottom line in 2017. And so their comprehensive profit from everything was actually, as you see, much bigger, right, than the net income from just operating activities that they, continuing operations that they would normally have. Okay. And so there's a big difference here. And the difference is these unusual items. The discontinued operations is the first unusual item, and this other income, comprehensive income, which is going to be explained shortly. Okay. So the first thing that's noticed, and this is on page 649, is that discontinued operations usually means that the company has disposed, discontinued, or sold off a significant component of what it does. Okay, so this happened to General Electric some time ago. The General Electric was doing all different types of things. They had a finance arm. Of course, they owned NBC at one point in time. They had a jet engine issue, etc. they sold a lot of those off. So when they actually sell off a significant part of themselves, that's going to show up as a discontinued operation, and they're going to have to show to its owners if they actually made a profit or a loss on the disposal of that. Remember, the last time we saw the word disposal of anything was back in property, plant, and equipment in chapter 9, when we disposed property, plant, and equipment, and we had to calculate a gain or a loss, right? And so that's what this part B is saying here, is that the income statement will be affected by this because you have to report a gain or a loss after taxes from what happened from the fact that you sold off or disposed of a big part of your business. You know, so this is part of discontinued operations and its effect. Now, again, it's going to be different than what's actually sustainable, because how often can you sell off a significant part of yourself? Not very often. Right? So that's important. So here's an example that's provided for you, and this is also in your book on page, it's 649. It's part of the, it's not a separate model illustration. It's just it's part of the writing in the book. And so here it shows that in 2017, this energy company, Acro Energy, had a profit of $800,000 before taxes. Okay. However, you have to know that they discontinued and sold a chemical division. Okay. And they took a loss on that chemical division of $140,000. Okay. I'm sorry, they took a loss from the operations, for $140,000. They took a loss on the disposal of the division to the other company of $70,000. Now, there's two different things. So when they actually close operations, there's a lot, you're letting people go, right? So if you close down a plant or a factory, there's costs from that operation that's going to result in a loss for you. And so you're going to have to pay people their severance. There may be healthcare. There might be other types of expenses when you lay people off from a division. Of course, it's no fault of their own that you sold it, and so there are costs that are involved from the operation. So in this case, there are costs from operations when you closed it, $140,000. Then when you actually sold it off to whoever bought it, you had another loss of $70,000. So again, this illustration is on page 649 in your book, right in the middle of the book, in fact. Okay. So here we're assuming a 30% tax rate, and here they're indicating us, prepare the statement of comprehensive income, knowing they started with a $800,000 profit before taxes and all this other stuff happened. So just again, you want to reference all this other stuff as we're looking at the next slide here. This is also on page 649. Okay, so if you're in your book, page 649 is the place to be looking. And this is the statement of comprehensive income showing all that activity. Okay, so they have the profit before income tax of $800,000. They're assuming a 30% tax. So $240,000 is their income tax expense. And this is their income or their profit from continued operations. Okay, so that's the first part of it. And then you're adding all of the discontinued stuff to this income statement, showing that you took a loss when you actually closed the operation of the division, and you had yet a loss when you actually sold it off to the other company. Okay, so these two losses are going to shrink your income, right? Because this is your profit from continuing operation. Now you just have to indicate that you discontinued some operations and you're taking a loss on that. That takes out of your profit. And so your actual net income for that particular year is going to be showing as much lower than what your actual profit was, right? So this is what your actual profit is for the year. But after you tell your owners about the unusual activity, which is selling off that division, you see how it's impacted your overall profitability, okay? And so that's why it's important that we disclose the discontinued operation, but understand that we only are going to be doing these types of things once in a while, okay? And so they are going to affect the quality of the profit for the year, right? So the profit for 2017 could have been $560,000 of profit, but after you take all this loss into consideration, the profit that stockholders are going to have is much smaller. At least it's a profit, so hopefully they'll be happy with that. So your book shows that these unusual items should be what we call non-recurring items, okay? And so these are unusual things that happen that cost the company money and affect its profitability for that period of time. And so this is important to read. This is also on page, this is on the bottom of page 649, to indicate that, you know, companies incur all types of these charges as they try to reduce costs. Oftentimes they might hire a company like an accounting firm, an accounting giant, to come in and restructure its costs and or help them sell off a business or redo things, become more efficient. Those restructuring charges basically are considered non-recurring, although it depends on the company. Some companies are going through some rapid change that they've actually had these non-recurring costs recur over and over again for a number of months, so for a number of quarters. So here they have the example of Procter & Gamble having this restructuring charge, but they showed it in 12 consecutive quarters. So 3 years in a row, they were showing that these were unusual charges that showed up on their income statement. And Motorola, hello Moto, they had these special charges for 14 consecutive quarters, okay? And so again, restructuring a corporation as large as Procter & Gamble and Motorola would take a long time, years. And so they'd be carrying these unusual items for a few years, okay? And then as your book goes on the other hand, there are other companies that have had their restructuring charges just once in a long period of time, like a once in a 5-year period or once in a 10-year period, okay? And so it's important to understand that these unusual items are going to affect the bottom line of a company when you look at the income statement. So again, how frequently is it going to happen? That's one of those things. Okay. The other issue that this part of the chapter brings up is something called comprehensive income. Here you want to turn to page 650 to read more about that. Okay. Not the best 5 I've ever written, but it is what it is. And so basically, if there's any changes to stockholders' equity, okay, it would be comprehensive income would affect those types of changes. Certain gains and losses would basically be passed on strictly to stockholders' equity. They wouldn't actually affect net income, but yet they affect the owners. And so your book gives the example here of unrealized gain or loss on the available for sale securities that a company might own. This also impacts companies that have pension funds and contributions to pension funds. Any unrealized gain or loss on some of those things are going to impact the owners without actually impacting net income. So here's an illustration that's provided for you in the book. This is also on page 650. Okay. And it shows here that it gives you an explanation that the accounting standards that we use, okay, so GAAP, require companies to adjust the value of the ownership of their ownership of stocks and bonds at the end of each accounting period. So if a company owns stocks and bonds, securities available for sale is what they're usually called. And those and they own it on the balance sheet at a certain value. And then at the end of the next quarter, the value of those securities changed. Well, they have to report that as part of their comprehensive income. Okay. So it's very interesting how they require that to do. So here's the illustration of how it would work, okay, for a company called Stasi Company. They purchased stock in IBM, don't know why, for $10,000 as an investment back in during 2017. Okay, so they bought it for $10,000. That's the amount, that's the value of the stock investment in IBM that Stasi made. However, at the end of 2017, the value of the stock was only $8,000. So if the company invested $10,000 in IBM stock, and at the end of the period, it's worth $8,000. They didn't sell it, that's just the value, right? So that means that the balance sheet for those investments are off by $2,000. So technically, what we would say is it's an unrealized loss. It's unrealized because we didn't sell the stock, so it's not a real loss. It's a paper loss, right? The value of the stock went from $10,000 to $8,000. So that $2,000 of value has disappeared because the stock price has changed. And so we have to account for the unrealized $2,000 loss, okay? And that's basically what you're going to be shown here. Okay, so the book explains how should this company account for the unrealized loss. Okay, so the answer, as you see here, is it depends on how they classify the stock, because there's actually two ways they can classify the stock within their own company. They can look at it as a trading security, or they could look at it as a security available for sale. Your book explains this pretty good. So basically, a trading security is bought and held primarily for the near term. So a trading security would be, in essence, a short-term investment that the company has been making. And if that happened, if they had a short-term investment, and that short-term investment changed in price, it would change the income statement for that period. However, if it's a long-term investment, available for sale securities, and your book classifies that as they're held with the intent of selling them sometime in the future. So that's a long-term security, long-term investment. Right. So the trading security would be part of current assets, right? Available security for sale is a long-term investment, so that would be part of LTI, long-term investments. Okay, so the different classification. So if it's a current asset, meaning that they probably are going to trade it in and turn it into cash at some point soon, and the value changes, it's going to affect the income statement as an unrealized loss or gain. However, if it's a long-term investment on their balance sheet, and the stock price in this case has changed by $2,000, the only thing that's going to be affected, right, is the stockholders' equity is going to be affected. The stockholders have to show that they've basically eaten that loss temporarily until the price changes next quarter. And so that's basically the difference. Whether it's short-term or long-term, it's either going to affect the income statement or it won't. Okay, it'll simply affect the stockholders' equity. So here, format number 1 is listed here as on page, this is also on page 650. Okay. And this is showing that this is a combined statement of income and comprehensive income, showing that, again, the unrealized loss of $2,000 is going to affect their comprehensive income, okay? Not their net income, but the comprehensive income is going to be affected because the comprehensive income is what's literally owned by the stockholder. Format number 2 is a larger statement in the balance sheet that actually shows a separate account under stockholders' equity for these changes in the value of investments. And so here they have an accumulated other comprehensive income or loss, and you see that $2,000 loss in value of IBM stock takes away from stockholders' equity. This is on the balance sheet versus the other one, which is on the income statement. Putting it all together is on page 651. It's another company here in your book that shows a statement of comprehensive income that shows you both of these things in action. Well, what do I mean by that? It shows you the discontinued operations in action, and it shows you the other comprehensive income for that unrealized, in this case, it's an unrealized gain. So the income statement looks pretty normal up to this point because we can understand that we've all seen this. Okay? Net sales minus cost of goods sold gives us gross profit. We subtract our operating expenses. We get the profit from operating. We have our other category because it's a multi-step, excuse me, multi-step income statement. Gives us our profit before taxes. We're using a 30% tax in this example for that. And so our income or our profit from continued operations is listed as $46,200, okay? So that's basically, we could look at that as sustainable. All the other stuff here are the unusual items. We had a loss from the operation of our plastics division. And so in this case, we had to lay off a whole bunch of people as we discontinue this, and it costs our operations $42,000, okay? And so this would be like a blah, right? A lot of money lost when we close a division. However, when we actually sold it, we actually made money on it. So we actually got a $35,000 profit from actually selling the division, when you look at the assets, to the other company. The difference between those two would be a $7,000 loss from discontinued operations. That's the combination of the total loss in operation plus the gain from selling it. So now our net income, as you see, is $32,900 after taking into consideration the discontinued operations. But now we have this other comprehensive income because we actually had an unrealized gain on these securities, okay? And that gain is $10,000 gain. And so it actually added to our net income, comprehensive income, for $49,700. This is going to impact the stockholders' equity section with that unrealized gain. Hey, excuse me. Okay. So there's another thing that this looks at in terms of the quality of the earnings that happens when they report. Well, some companies change a few parts of their accounting principles if they need to, okay? The business usually changes over time, and so the accounting principles can change over time if the company feels it's in their best interest to use a new accounting method. And so an example is given to you here where a company that has traditionally used FIFO has seen that their costs have changed over time. And FIFO just, it doesn't really work for them anymore. It's better to actually go to an average cost method. So if they report a change from FIFO to average cost, it's obviously going to affect their financial statements because that's going to affect their cost of goods sold, which will affect their gross profit, et cetera. And it's going to affect the value of their inventory on their balance sheet. And so if a company's core businesses have changed and they feel the need to change an accounting principle, like in this case, the inventory method, it's going to impact the financial statements, okay? They can do that when management can show that changing over to these other principles, whatever is they're changing, is preferable for the company. It's a more accurate way. And then once they do that, they have to go back and literally change the financial statements retroactively so they can actually then have good comparative statements. Because you can't compare an income statement using FIFO to an income statement using average cost or any other changes that they might make, and sort of be able to compare those rationally. So that's not going to happen. Okay. Here again is a nice little story. This is on page 652 here. And it just basically shows that companies that have pension plans, okay, have needed to adjust to this as well, because as pension plans go up and down, they will need to show that volatility, and that might affect, if not their net income, certainly their stockholders' equity, as they have unrealized gains and losses that they have to adjust for. So that's the article that came from the Wall Street Journal back in 2012. And again, once companies are doing this and they can switch certain methods in which they do it, they might see, in this case, UPS had a charge, they had a loss, right, that they had to account for of $827 million. I mean, that's a huge loss, right? So that has to show up in, it's either going to affect their income statement or their balance sheet with comprehensive income. And so, you know, again, they did this change because they thought it would no longer distort the results, and it would result in better transparency So when they changed those methods over, it created this loss or this charge, but it's something that was in the best interest of the company to show a more accurate financial statement. Okay, so the last part of this, quality of earnings here. Basically, you know, in order to have a very high quality of earnings, the information that is presented has to be as full as possible and as transparent as possible, because you do not want to look at the financial statements and be misinformed, right, or misled by the information. Okay. Sadly, of course, you know, we've had a lot of accounting scandals that that are mentioned, that WorldCom, Enron, among others, they didn't put very good information, full information, on their financial statements, and it made the companies look a lot better off than they were. And once the full disclosure came out, once it became known that they were hiding certain things, well, it was too late, right? Companies are often manipulate their accounting records because they want to show their owners, the stockholders, that they're more profitable and that they're doing a good job managing. And so management sometimes can get a bit out of hand and not do the right thing, just to impress their owners of how good they're managing the company for them. So again, certain things will affect earnings, right? So again, if you switched over from FIFO to LIFO or whatever, that's going to have an impact on earnings as well. One thing that's really come up as an interesting way of communicating what's sustainable and what's not is there's pro forma income statements that have been developed to show that this is how we're really doing, and they exclude all those unusual or non-recurring issues from it. Just as a way to compare, you know, we have these pro forma numbers that show the core business is solid. But when you add all this other unusual stuff that's going on, it doesn't look like our company's doing as well. And so you can see they're trying to separate those to show the company's doing better than we thought. And of course, your this particular chapter ends with some management abusing things. They recognize things improperly. And so the abuses are listed here. Improperly managing or recognizing revenue. Because when you recognize revenue, right, what's part of revenue? Revenue covers the expenses and gives you a profit. So if you improperly recognize revenue, you can inflate your profit. You inflate your sales, you inflate your profit. That's called channel stuffing. Very interesting. Not what you would have in your turkey. It's a different type of stuffing. But this stuffing happens in accounting. They also will improperly show operating expenses, or they fail to report liabilities, all of which create, you know, bad numbers and give a very misleading view that the company is much better off than it is. Okay, and this has happened before. And this is what, of course, this is what the SOX Act that we learned way back in chapter 2, right, is dealing with. You know, management can now literally go to jail. There's some teeth in the law that say, look, if you do this, and you know you're doing it, and we can prove you knew that you were misleading on purpose, you're going to jail. You're going to jail. Okay, so this unusual item is where we're going to be starting. This is the do it exercise for this learning objective. It's on the bottom of page 653, and it goes on to 654. Okay, so here is what we are looking at. A company called Air Corporation. Sounds interesting. Hope it has some lift to it. Oh, okay. I'm not getting enough air. Oh, okay. So here's some information. They report income, right? That's their profit before income tax. Remember, income is another word for earnings or profit, right? So it's their profit before income taxes of 400,000. But they have an unrealized gain, right, that they must show. They have some income tax that they must show. They have a loss from operation of their flour division. Oh, I guess their flours didn't get enough air, of $50,000. And they lost money when they actually sold off the flour division. Ooh, it's going to cost them a few petals. $90,000 there. Okay. Income taxes are 30%. That's the rate they're going to use. And again, this tells us we're going to prepare a correct statement of comprehensive income, beginning with our income before taxes. So this we've actually already seen way back on page 649 is the one we saw for acro energy. So it's going to look like that. As you see here, we have Air Corporation. Okay. At the end of November, it had a $400,000 profit before income taxes. It had $120,000 of income taxes. And so its income from continued operations was $280,000. From that, you're showing the unusual stuff, right? So the first unusual item that's listed is your discontinued operation. And your discontinued operation, sadly, cost you money. You had a loss on the operation, closing it down, right? And a loss on disposing your flour division, right? You lost many, many petals here. And so you had, this would normally would be in red, right? Showing the losses here from this, which means that you took a $98,000 hit from that discontinued operation. That actually gives you your net income for 2017. From your net income, you have your other comprehensive stuff that you need to show, which in this case is an unrealized gain, okay, on these long-term securities. And so that unrealized gain was $70,000. That's going to prop up your comprehensive profit to $252, okay, which will ultimately just benefit the stockholders. Okay. So I'm going to go ahead and do that, and I'm actually going to stop the recording here.